October 27, 1997, Black Monday revisited. The United States stock market experienced its most dramatic decline in a decade. The Dow Jones Industrial Average fell 554.26 points, or about 7.18%, closing at 7,161.15. This sudden drop triggered market circuit breakers, mechanisms designed to temporarily halt trading when losses reach a specified threshold. These automatic pauses, introduced after the 1987 crash, aimed to prevent panic selling and restore order to the markets. On that autumn day, their effectiveness was put to a serious test, as the trading day ended early under extraordinary circumstances. The 1997 decline occurred amid global financial instability originating in East Asia. In July 1997, Thailand floated its currency, the baht, leading to a wave of devaluations across the region. Investors grew increasingly concerned about the exposure of American companies to Asian markets. As panic spread through international exchanges, the pressure reached Wall Street. By late October, U.S. traders reacted to heavy losses in Hong Kong and other Asian financial centers. The Dow's massive drop on October 27 reflected the transmission of fear across borders, a clear example of how interconnected global markets had become by the late 20th century. The circuit breaker mechanisms were implemented for the first time since their establishment following the 1987 market crash. After the Dow dropped 350 points, a 30-minute pause was initiated. When the index continued its descent past 550 points, a second suspension ended trading for the day. This halt occurred at 3:30 p.m. Eastern Time, preventing additional selling that might have deepened the decline. The use of circuit breakers demonstrated the commitment of market regulators, including the Securities and Exchange Commission and the New York Stock Exchange, to maintain market stability through structured intervention. Financial historians identify October 27, 1997, as a milestone in modern market regulation. The event validated the concept of automated controls designed to mitigate systemic risk. It also revealed their limitations. Although the circuit breakers stopped the immediate slide, the market's volatility continued into the following day, when the Dow initially fell another 186 points before rebounding sharply. The recovery demonstrated investor confidence in the underlying strength of the U.S. economy, yet it also exposed how quickly global anxiety could trigger domestic instability. Contemporary accounts emphasized that the 1990 sell-off did not represent a structural collapse comparable to 1929 or 1987. Economic fundamentals remained strong, corporate earnings were robust, and inflation was low. The decline reflected investor reaction to external uncertainty rather than internal economic weakness. Nevertheless, the event underscored the increasing role of computerized trading and global information flows in shaping market behavior. Automated sell orders amplified the speed and scale of the decline, prompting renewed discussion among regulators about the risks of program trading. The Federal Reserve, led by Chairman Alan Greenspan, closely monitored the situation but chose not to intervene directly. Instead, officials emphasized the importance of maintaining liquidity in the financial system and allowed the market to stabilize naturally. This response was widely viewed as a vote of confidence in the market's capacity for self-correction. By the end of the week, the Dow recovered most of its losses, reassuring investors that the plunge was a temporary shock rather than a precursor to a broader crisis. The 1997 market plunge also had long-term policy effects. Following a review by the SEC and the Commodity Futures Trading Commission, the parameters of circuit breakers were adjusted to reflect percentage-based declines rather than point drops. This change ensured that as market levels rose over time, trading halts would remain proportionate to market scale. The event thus became a catalyst for refining regulatory tools that balance market freedom with protective mechanisms. In retrospect, the October 27, 1997, serves as a case study in the interaction between global financial systems and national market controls. It illustrated how rapid capital movement could transmit shock across continents within hours. It also highlighted the need for coordination among international financial authorities to manage volatility in an era of globalized investment. While the Asian financial crisis continued into 1998, the U.S. market's resilience reinforced global confidence in the American financial infrastructure. Economists and historians continue to reference the 1997 plunge as a turning point in the evolution of market safeguards. The event demonstrated that panic could be contained through transparent rules and temporary pauses. It also reinforced the principle that markets could absorb external shocks without collapsing. Though often overshadowed by larger crashes, the 1997 decline represents a critical episode in the development of modern financial regulation and the ongoing balance between market efficiency and stability. For enthusiasts of historical ephemera, visit history-collectors.com to find collectibles that might complement your collection. You can own a piece of history.